Okay, welcome to the Left Field Investors Lunch and Learn. We are today unveiling InvestWise Collective, and we are really excited. The guys here on the panel, Paul, Pat, and Ryan, have really been working hard for the last, 6 months to get this together, maybe more. They've done a fantastic job. We're super excited. It is the next evolution of our community, and the goal really is to get the community engaged in these deals and we're trying to turn community into a verb where we're going to community deals and analyze and vet them together. And what better way to do that than to form InvestWise Collective and have the group come together and look at these deals through the underwriting acumen of the group that we have here, which is pretty stellar. So I'm really excited about it. As I've said, we're investing in these deals, and we want to bring LFI members alongside us to get into these deals. We are going to find quality deals. We're going to look at them. It's still going to be a little bit DIY. You're going to make the choice whether you want to jump in or not, but you're going to be able to leverage the knowledge of the team that we've put together. And so, as I said, we're excited about that. There are 3 fund managers of InvestWise Collective, and they should all be familiar with to you. One is Ryan Stieg. He is one of the founders of LFI. Pat Wills, he's operations in LFI. He's the computer guy, but much, much more. And we're so thrilled with all the work that he's been doing with us. And then lastly, Paul Shannon, who is the principal at Red Hawk Real Estate. And he syndicates his own deals. He's an investor. He's an infielder. If you follow him on LinkedIn, he crushes it with his content. And we're super excited to have him part of this group as well. So with that, I want to turn it over to these guys. As I said, I've said it like 4 times already. I am really excited about this. And for the next hour, we're going to kind of explain what InvestWise Collective is, how it can work for you, and what it's all about. So Paul, Pat, Ryan, thank you so much for bringing this to us, and take it away from here.
Thank you very much, Jim. Grateful for the platform to be able to introduce InvestWise Collective today and the audience here. So appreciate your attendance and looking forward to getting into the meat of the presentation. I'm Paul Shannon. I'm one of the fund managers, as Jim pointed out. I'm going to go ahead and share my screen here so we can get into the presentation. Let's do. Okay, is that visible to everybody?
Yep.
All right, we got a green light. All right, guys, so I'm going to try to keep this to 30 minutes, 40 minutes tops, hopefully, if I don't ramble. So there's enough time at the end for Q&A. So I just ask that you keep your questions to the end of the presentation. I may end up answering them as we go through the slides. Jumping into the agenda, first we'll do some introductions. We want to talk a little bit about why we think now is a good time to invest in commercial real estate, but we also want to take a balanced approach and explain why we think it might not be as well. With that, we want to help you understand how we're mitigating some of the macro, sponsor, and deal level risk. We're going to talk about how InvestWise Collective works, the actual fund itself, what asset classes we're targeting, and then what makes us a little bit different than some of the other funds that you may be familiar with out there. But before we get into the body of the presentation, I wanted to introduce Ryan Stieg and Pat Wills. You guys want to say a few words?
Sure, I'll go first. My name is Ryan Stieg. As Jim said, I am one of the LFI founders. My background, at least in real estate anyway, I started with a single family rental in 2007 as an accidental landlord. Waited a while and started building a turnkey portfolio in 2016 and realized that wasn't as scalable as I'd like, or as passive as I'd like it to have been. I turned in 2018 to passive syndications and haven't looked back since. I still hold that real estate portfolio of about 10 units across 5 states. But since then, as a passive investor, I have invested either directly or through TribeVest in a group that you guys are all very familiar with. Invested in many different asset classes across the portfolio, and I'm in over 60 deals, either in a group or direct invested. So I've seen the gamut of deals that have gone good and gone bad, and now looking to focus that attention through InvestWise Collective. And so with that, Pat, I'll pass it over to you.
Thanks, Ryan. My journey is pretty similar to Ryan's, except a decade later. I jumped into the turnkey space in 2017, and like Ryan, very quickly realized that it's not scalable, it's not passive. And you're also very limited to certain types of asset classes. You don't get the full range of asset classes available to you that syndications provide. There's also an enormous misalignment with property managers where they basically make their money through repairs and turns rather than keeping a paying good tenant in the property. So that kind of turned me off to turnkeys in general and jumped into syndications in 2019 and then found LFI in 2021 and jumped in there with both feet as well. Haven't really looked back.
Thank you, guys. I've got a fancy slide to put up here for my background. I am an active and passive investor. I've been investing actively and passively, actively since 2016, passively since about 2017. I'm mostly a buy and hold guy, but I do like to do some fix and flips here to create some additional capital to reinvest to create some more income. So mostly longer term holds, but do some selling as well. My current portfolio is over 100 units on the active side, mostly multifamily, two larger properties that comprise most of that portfolio, and then some single families. We've been buying more single families actually this year, but have transacted on over 175 properties. Again, a lot of that stuff is either fix and flips or we did some de-risking during COVID and sold into a high market. From a passive standpoint, I'm currently in 14 different positions. I've not invested in any tribes before. So this is all single investing, just doing it myself with my wife. And we've done a host of different asset classes, multifamily, mostly outside of my local geography since I'm doing that actively here. This is more in the Sun Belt, Texas, Arizona, to kind of take advantage of some of the demographic trends that have been an advantage to those markets. I've done triple net, industrial, sale leasebacks, invested in ATMs. I've done some debt positions, first and second position notes, on some mixed use development. Just got into my first private equity deal this year, self-storage, etc. I think I hit it all there. So, but mostly from an overall kind of theology standpoint, I'm more cash flow focused over speculation. So let's get into the body of the presentation here and talk a little bit about why real estate is a good investment right now. So just from a general standpoint, I like this acronym to kind of describe real estate to people that are new to the asset class in general. So real estate is the ideal investment, and the acronym goes something like this. So I is for income. Real estate pays fantastic income, better than you could find with like a bond or a dividend paying stock. So if you're looking for a way to kind of create income outside of your W-2 job, whether it's active or passive, real estate is a great avenue. Tax benefits through depreciation, paper losses that are created from using bonus depreciation and cost segregation in particular can help shelter the income that real estate affords, but also has additional tax benefits if you've got passive gains and other positions in your portfolio. Equity buildup. So while you hold the property, you're actually having your tenants pay down the debt, which is fantastic because it builds up your equity over time. Appreciation, real estate tends to appreciate over time as you hold it. And of course, you can use leverage with real estate, which you can with other assets too. You can use a margin account to invest in stocks, et cetera. But having a hard tangible asset behind that leverage typically allows for less volatility and less risk. So while also juicing returns. So I think ideal stands for what real estate is. It's just the best asset there is out there. Now, why is it a good time to invest in real estate, particularly now in the macro environment we're in? This is an interesting chart I pulled. This is the consumer price index less shelter. So it's excluding shelter because shelter is typically a lagged data point in the CPI. So if you look at this data here, you can see back during COVID, we started to see a lot of money being put into the market. M2 was up. The Fed was printing quote unquote money at this point. And inflation really started to peak here towards the beginning of 2022. Here it's sort of tailed off, and we've got a little bit more certainty, I think, around where interest rates are or where they may be headed. It looks like the Fed is potentially going to do 1/4 point more hike, and from there kind of lay off the gas a little bit and just see where the economy is. But it seems as if inflation has come down a bit. That's not to say that we can't see a double top like they saw in the 1970s. A lot of the CPI is driven off of food and energy. And energy prices have come way down. So if energy goes back up, we may see these numbers peak again. But I think when it comes to real estate, it's beneficial to kind of have a handle on where inflation is. When you thought about COVID and during this time period, inflation was really spiking up, and you heard a lot of sponsors and syndicators talking about how inflation was a hedge, or real estate was a hedge for inflation because typically rents outpace the CPI and grow, and that obviously impacts net operating income and is a positive for property valuations. But that's only true to a certain point. Right around this time period, you started to hear about Jerome Powell talking about, hey, we're at almost 9% inflation at this point. The 10-year Treasury was below 1% at that point, and he was telegraphing interest rate hikes. And if you study financial history at all, you know that that can kind of happen over a quick period of time. We haven't seen anything like it in over 40 years. But interest rates and cap rates are very heavily correlated. So we're not 100% correlated, but when interest rates go up, it increases the cost of capital, and it kind of restricts the amounts that buyers can pay to get the same returns. So at this point, it started to look like it might be a little bit difficult to pencil deals, although a lot of people saw it differently and acquired with bridge debt and floating rate debt. And we see where a lot of those deals are today. So I think today, even though we'll talk about this a little bit more later in the presentation, the headlines are picking up on some of the distress in real estate. Most of those deals were acquired back in this time, especially as it relates to multifamily. So again, yesterday's news is making today's headlines. If you're picking up on what the media is saying, with the exception of office, a lot of the deals that were getting done were done in the last few years with floating rate debt, aggressive underwriting assumptions, presuming that rent growth would extend long into the future. And we're kind of seeing that a lot of those things are coming to fruition today in a negative light. Office is a bit different. COVID obviously changed the game with the work from home trends that seem to be here to stay. And some of those assets were acquired 6-7 years ago, and it'd be very difficult to predict when their loans matured, what they'd be facing today. So we're kind of looking at things with cautious optimism. We think we have kind of a unique position in the market, and we fill a need on both sides of the table for the LP as well as the GP with our InvestWise Collective funds. Sponsors are going to be more flexible with terms today because loan proceeds are lower loan to values. They have to bring more equity to deals to get them done. So with the need for more equity, they want to kind of streamline their capital sources. Instead of raising money from 20 individual check writers at $50,000 a piece to get to $1 million, that's a lot of work for them. If they can come to one firm or one fund like ours and have one check be written and deal with one individual or one fund, that's a big value add to them, no pun intended. So they need capital, and it's also, because of the aforementioned issues with some of the multifamily deals that have gone, to capital calls or pause distributions, sentiment is down in the marketplace, right? Whether it's right or wrong, because again, today's headlines are yesterday's news. It's harder to raise capital. So instead of making 20 phone calls, it may take them 60 phone calls to raise the equity they need. So again, if we can do that for them, they can focus on operations and we can focus on their capital needs. We offer a solution for kind of an awkward check size too. And what I mean by that is, institutions, family offices, these are, multi-million-dollar check writers. $5 million sometimes is their minimum investment. Retail investors like you and I, $25,000, $50,000, maybe $100,000 check. If we can come in as a fund and offer between $500,000 and $2 million, we can effectively solve a problem for them in that awkward check size range. And they can offer us better flexible terms that we can pass on to our investors. And I just love this slide because obviously Warren Buffett's track record speaks for itself, but being fearful when others are greedy and greedy when others are fearful. Again, when it looked like nothing could go wrong, rent growth was through the roof, asset valuations were flying high. You had syndicators that were brand new on the scene that all of a sudden had track records of gold. That was probably the time to be fearful when everyone was greedy. Today, you're seeing a little bit reluctance in the marketplace. You're seeing people let off the gas a little bit and be concerned. I'm not saying that we are being greedy right now, but again, we're being cautiously optimistic and trying to hunt for yield and opportunity where there might present itself. Okay, so let's offer the balanced view here. Why is now not a good time to invest in real estate? Well, one thing is there's a thing called the cap rate spread. Okay, this is the cap rate of any given asset in any given geography over the risk-free rate of return, which typically is measured by the 10-year treasury. But really anything that, let's take a high yield savings account right now that's paying 5%, or if you want to compare a little bit more apples to apples, maybe it's a triple B rated bond that's paying like 6%. Well, if a cap rate is 6% on a, let's say an industrial property, and I can get 6% in a CD or a triple B rated bond, I'm not really being compensated for the risk that I'm taking, because real estate, private market real estate, inherently is more risky than these other risk-free alternatives. So we're thinking that probably the cap rate is going to expand from where it was at, say, 3.5 to 5 across that range in asset class and geography a few years ago. It's probably looking more like 6 to 8. But there's still kind of some lag there, and that cap rate is expanding as we speak, really. So we want to be sure that we're getting compensated, but also that we have a stabilized yield, and I'll talk more about this a little bit later too, that's well above the market cap rate. So we're allowing for that cap rate to decompress, but through our value add plan, our business plan, the sponsor's business plan, the property will be well above that cap rate when it's operating efficiently and it's stabilized. So we've protected principal and we know that we've made a profit. Again, alternative investments, competing for investor capital. I personally have a fair bit of capital sitting in a high yield savings account, and I'm waiting for an opportunity to come along in real estate that really catches my attention. We're shifting into this fund model, and I'm shifting more into passive investing because I think there's a lot more opportunities out there than just in multifamily and real estate. And I'm on the hunt for those types of deals. In the active space in my market, the bid and the ask are pretty far apart. So as that bid and the ask closes and sellers kind of adjust their expectations to where the market is today, and cap rates do expand up, there will be buyers at some point that meet them. Right now, there's kind of a stalemate, but we think that that is kind of closing and opportunities are on the horizon. I threw in here too, just a fun fact on historical cap rate spreads. So this is the spread above the risk-free rate of return. You can see there for the 4 popular asset classes what those spreads are. So again, a decompressing cap rate. We saw a ton of cap rate compression post-COVID with all the money that flooded the system and people chasing assets. Now we're seeing the opposite occur as interest rates have gone up to respond to inflation. This chart shows how property values are impacted as cap rates decompress or expand by 50 basis points. So let's take, for example, 4.5. Let's start here. Assuming across the board that NOI is $100,000 for simplicity's sake, 4.5 cap rate applied to $100,000, and NOI would be 2.22 million valuation. If that property were to expand up to 5% cap rate market, it would be a reduction of over 9% in property value, would only be worth 2 million. And you'd have to grow NOI by 10% to offset the declining valuation, just to keep the valuation at 2.2 like it was before, if that makes sense. So this is what's going on with a lot of operators right now who are facing this cap rate decompression, is that they're trying to outpace even their pro forma projections on NOI growth to kind of combat the cap rate rising. And they're up against the wall in a lot of cases with maturity risk and having debt that comes due at some point in the near future to execute this sooner rather than later. So, and again, this is in properties that are already acquired. There could be some distress in the market, which we hope we have a chance to capitalize on, although we think that institutions will probably get the majority of those looks, and there won't be as much distress. It'll all get worked out probably with a lot of lenders that are willing to work with their borrowers, but new acquisitions will not face this same challenge. So it's not necessarily time to panic about acquiring real estate today. It's just to say that, again, the headlines of today are yesterday's news. So how are we handling risk mitigation within the InvestWise Collective Fund? One of the things I mentioned earlier was we're trying to create yield, a stabilized yield that's comfortably ahead of the market cap rate. And I'm going to break that down in an example so it's easier to digest. Let's take a poor example here so you can see what happens when you don't take yield on cost into consideration. So This is an example of a property bought in a 5 cap market, a $20 million purchase price. Let's assume that the going in place net operating income is 900,000. So that produces a going in cap rate of 4.5%. We're actually under the market cap rate at this purchase price, which isn't necessarily a bad thing. We may be paying the seller for the opportunity for a growing income stream. Our pro forma NOI estimate is 1.1 million. We think we can add $200,000 to the NOI. We're going to spend 2 million in capex to get there for a total project cost of 22 million. This obviously doesn't account for reserves or lender costs, just for simplicity for the example. So in this case, the yield on cost would be the total project cost. It's the pro forma NOI divided by the total project cost, which equals 5%. Okay, that's the same as the market cap rate. So if the market cap rate were to expand and decompress to a 5.5 or a 6, we would be underwater on this property. We would start to lose equity. The operator in this case paid stabilized pricing and didn't really add any value. They probably went through 12 to 24 months of work and it didn't show much for it. And you'd be surprised at how many deals out there end up in this scenario and how few operators understand this concept. You'll probably won't see it on an offering memorandum, or sometimes it's not in the underwriting. So critical to calculate this stuff. Here's a positive example: 5 cap market, $20 million purchase price, 900,000 in place NOI. This is the same exact example so far. The pro forma NOI estimate is 1.3 million. Okay, a little bit more than last time. We're going to spend 2 million on the capex. Total project cost 22 million. So 1.3 million, the pro forma NOI projection divided by the total project cost is 5.9%. So that's higher than the market cap rate. Okay, and that spread is called the development spread, and it's 90 basis points in this case. So even if the cap rate, let's say, expanded by 50 basis points, that would leave us with 40 basis points above the market cap rate. And we know that we've actually created some value there, albeit in that scenario, not as much as we would have hoped. But if the market cap rate were to stay the same, the lift on that property as a percentage, we have created 18% additional value in that property. So this is the calculation that we take very seriously. This is what we look at when we underwrite value add deals, no matter the asset class, and something we hope that our operators are understanding as well. And if they don't, we're probably not investing with them. As it relates to sponsor and deal structure risks, alignment of interest is just critical. I mean, I see so often misalignment of interest, and it leads to poor outcomes over the long haul, no matter the deal. And you have to understand a few things about this business to really know where that comes from. Number one is that sponsors do not make money without deals. So some of them are very motivated just to transact. Their skin in the game oftentimes can just come from fees. If they take a large acquisition fee on the front end and then they never actually take ownership of that, and then they reinvest it into the deal, is that really skin in the game? Is that coming out of their family nest egg? No, it's not. So we really want to know that there is actually skin in the game on their behalf, and if they lose, they're not going to be happy either. A truth that I see in the industry, and it shouldn't be this way, is that it's much easier to spend money that isn't yours, unfortunately. So we want to be, teaming up with operators that look at our capital more importantly than their own. They couldn't sleep at night if they lost our money. So that's who we want to be teaming up with. Another thing is that we see that there's a lack of patience. Like, people get tired of underwriting deal after deal and passing and passing and passing. Well, that's the name of the game. So too many people are getting caught up in assets under management or trying to grow their portfolio and being entrepreneurs before investors. And those two personality types are mutually exclusive. An entrepreneur will run through a brick wall when a challenge is faced and put in front of them. They'll do anything they can to keep on going and going and going. And that's great. But in investing, sometimes it pays to sit on the sidelines. Sometimes it pays to watch as others celebrate in the short term. But then later on, you're okay as they're experiencing pain, and you've been patient and are waiting to capitalize on other opportunities. So patience is one of our number one philosophies. Deal churning. This is similar to what I mentioned before about sponsors don't make money without deals. There's no shortage of deals out there. There's plenty of deals to invest in. However, there is a shortage of good deals in today's market, so we plan to find them. And we want to do so. I mentioned squeezing the spreadsheet and trying to make numbers work and adjusting here, adjusting there to try to justify a deal that's marginal to get done. This is just an example here of a deal that I underwrote in Indianapolis. It's a multifamily deal that I underwrote last year, and I've saved this example. But here are some of the assumptions that were used during my analysis. And this is when LTVs were a bit higher. You can't even get this today typically. Especially with an agency product. So loan to value 75%, annual rent growth 3%. The whole period was going to be 5 years, and the exit cap rate we were predicting was going to be a little bit higher than the going in market cap rate, which is 6%. Now, if we wanted to manipulate the spreadsheet, we could do so by juicing the leverage up to 80% from 75. That increases the IRR from 14.4 down here, based on these assumptions, up to 15.9. If I leave the LTV alone and all the other variables alone, and I just increase rent growth to 4% instead of 3%, I've juiced my IRR by 200 basis points up to 16.4. If I decrease my hold time from 5 years to 3 years, that hold time, since IRR is a function of the time of cash flows and the time in the market, the time of the hold, shorter equals higher when it comes to IRR. So we've juiced, again, the IRR up from here to 17%. And if I reduce the exit cap rate and assume that there's going to be no decompression and that the economy is going to expand, or cap rates are going to continue to compress, I can juice my IRR to 16.9. So if I adjust all 4 of these variables for the more aggressive assumptions versus these assumptions, we take the IRR from 14.4 up to 23.9, almost a 10% increase. So the point of this is to show you that we're not looking at the key metrics that you might see on an operating or an offering memorandum. We're not as concerned with IRR pro forma, cash on cash, equity multiples. These are all nice when they come true at the end of the deal, but not necessarily in the front end. We want to understand the inputs that go into these assumptions, these metrics that have been calculated, and really find out if they're actually realistic. So, studying the comparables in the area and the rents that they're charging, what they're asking is, the rent growth based off of loss to lease. And some of these leases that were signed during COVID that were really high, and there might be a small percentage of them at that rate, and the operator assuming they can get all those rents up to that number. Is the rent growth, just pre-COVID or COVID era time, growth? Is it 6% a year for the next 4 or 5 years? These are the things we want to kind of drill down into to make sure that there's reality to the situation. We'd rather take a 14% IRR that's conservative, that's risk adjusted, that's actually realistic, than to go out on the ledge and assume that a lot of things will come true and hope for a return, because hope is not an investing strategy. So from a sponsor standpoint, we're always going to want to know, like, and more importantly than all is trust the person that we're dealing with. A lot of the sponsors that we're in the fold with are people that I myself has invested with, that LFI might know has invested with. We're trying to find those that are good operators that aren't necessarily the best marketers. Some operators are just real estate guys. They're not on LinkedIn. They're not doing presentations. They don't know how to put together a PDF, but they know how to operate real estate, and they've been doing it for 20 years. I'd much rather be with a group like that, and we can help streamline their capital and their marketing, if you will, than have to worry about them operating the deal because they're so worried about where they're getting the next check from. So we want to make sure our interests are aligned, again, make sure they have reasonable fees and they're all disclosed, make sure they have skin in the game, understand their motivations. Is it just transaction based? Is it assets under management and scaling to 10,000 units? What is it that drives them? We really want, again, people that are fiduciaries of capital, that feel as though that our money is more important than their own, and understand their risk tolerance too. You can really understand a sponsor's risk tolerance when you see what they input into a spreadsheet to arrive at their returns or their projected returns. What debt strategy are they using? Does it match the business plan? Are they taking out short-term bridge? Are they are the returns subject to a refinance event? And without that refinance event, with all the assumptions around it, does the deal fail, et cetera, et cetera? So that's kind of just a general philosophy piece. I want to get into a little bit more of InvestWise Collective and help kind of understand the fund, what we're working towards, what our criteria is, and we can get into some questions after that. So the fund size is $20 million. The minimum investment into the fund is $50,000. And the deal minimum is 25. So you can actually slice up that initial investment of 50,000 into 2 allocations if you'd like to. We are a Reg D 506c3c1. So this is for accredited investors only. We do have to get an accreditation letter or be verified through some of the third-party sites to participate. And we're only allowed to have 99 unique participants or investors in the fund. And that's related to our Reg D exemption. So once we have those 99 investors, the fund is closed. We'll continue to make investments with the people who are in the fund, but we can no longer accept new investors. We're going to be looking at both debt and equity. From a hold period standpoint or time frame standpoint, our debt offerings are going to be between 6 months and 2 years typically. We're seeing some good opportunities in the short term, sort of rescue capital or gap funding type space right now. The projected returns in that realm are between 7 and 12% or even higher. As far as equity is concerned, a lot of stuff you guys have probably looked at, as have I, in the last few years have been short-term holds. That's aligned with the business plan in certain cases where people may have used short-term floating rate bridge debt or had early exits because of the market really accelerating, a couple of years ago, and the business plan being completed well ahead of schedule. I don't think we're going to see a lot of that moving forward. I think we're going to come to expect a little bit longer hold periods, maybe 5-7 years. I think 4 to 7 years is really going to be the average hold period within the fund as far as equity goes, but it could be as long as 10. The projected returns are probably going to be a touch lower, as well as I touched on earlier, with lower loan to values, more equity coming into the deals. That's going to, with less leverage, you're going to see the returns kind of be lowered. So we're targeting between 13 and 25% on a risk adjusted basis. The higher the returns, typically the risk is going to go up as well. Cash on cash between 6 and 10%, and equity multiples between 1.5 and 2. And those equity multiples will go up as the hold period increases if we're in a long-term position. So just to provide some clarity, because some people are confused about the fund minimum and the deal minimum, Pat put together this great slide on an example investor named Bob. So let's say that we present at InvestWise Collective an industrial deal in the Midwest, and Bob's interested in investing. The fund minimum is 50,000, so he signs the commitments, the PPM, and all the documents, and decides only to invest 25,000 in that particular deal. The other 25,000 would sit in similar to like a brokerage account, just in cash within the fund, and it's non-interest bearing. So the 25,000 in this example was allocated to the industrial deal. The other 25 is sitting in cash. Next month, the collective presents a retail center in the Southeast with an operator, and Bob doesn't really love the idea, so he passes on that opportunity. He has the right of refusal for that deal. He passes on the next deal as well, and then eventually our 4th deal comes out, and it's a multifamily deal in the Carolinas, and Bob loves it. He contributes his second 25,000. And he signs the specific deal disclosures for that deal. So that's kind of how it works in an example format. It's a 50,000 minimum to the fund, and then $25,000 per deal. In this example, if Bob were to continue to invest, he would only have to commit 25,000 if he wanted to just meet the minimum moving forward. These are some of the asset classes we're looking at, not restricting to, but some of these we feel have good, strong thesis behind them and have really good, solid risk-adjusted returns versus the risk-free rate. I particularly like these two right here, neighborhood retail strip centers and flex industrial, very strong supply and demand dynamics in our favor for those. I mentioned distressed real estate assets. That could be a good play here coming up over the next 6 to 18 months, I think. And short-term sort of debt, bridge funding, gap funding is also interesting. But all these asset classes are really interesting to us, and we hope that we can find some good opportunities within them. So what are the advantages to you guys, to the retail investor? versus just investing directly with an operator. So again, we're kind of solving that awkward check size, and we're streamlining the capital sources to the sponsor. So with that, we're going to be compensated through better terms. We're going to negotiate either better preferred return or a better promote structure, a waterfall structure, so that you guys come out ahead at that point when the deal does mature, and are hopefully paid better cash flow during the hold period as well. We're doing that through larger check sizes than typical $25,000, $50,000 allocations to the sponsor. And that way the sponsor can focus on operations versus capital. If it's not better terms, it might be better access. Just had a call with a sponsor this morning. Their minimum is $250,000. I can't write a check for that size. Most retail investors aren't putting that kind of money into an individual position. But if we collectively come together to meet a $250,000 minimum, we can get into institutional quality deals that we otherwise wouldn't have access to. And that could be $1 million minimum. It could be a $5 million minimum that we decide, okay, that's too much. But there are deals out there like that that we don't get looks at because we're kind of the retail guys on the small side of things. So I mentioned wanting to team up with operators, not marketers. And we want to align interests at the fund level with retail investors, with you guys, where we make money when you make money. And how we make money is essentially keeping a portion of the better negotiated terms. So we'll pass on better terms than you would get negotiating directly with the sponsor. But then if there is upside and the deal performs and we're successful, we're all successful, we get compensated through keeping a portion of that. So that might look like, for example, instead of a 60-40 split, you might get a 75-25 split, but we negotiated an 80-20 split. So we're going to keep that additional 5% when the deal does exit. Let's see. All right. So what makes us different? We're customizable. Okay. So I kind of touched on this as far as being able to allocate based on your interest in the position in the deal. We're not a blind pool fund. We're not going to give you a set of criteria, our buy box essentially, and then have you kind of stick to that criteria, wire us the funds, and then we go shopping. In this case, we have sort of a broad criteria, obviously, and we're going to try to diversify the fund amongst asset classes, operators, geographies, risk tolerance, et cetera. But if for whatever reason, what we find doesn't match your risk tolerance, you don't have to participate in that particular deal. You have the last right of refusal. We as the managers are on the hunt for yield. We want to invest our own money. So we're going to be investing in every single deal that we find, and we're going to pay the same net fees to the fund that you would. You essentially are the fourth manager with that fourth right of refusal. All three of us are going to have to agree as fund managers that we're going to invest in a particular deal. But again, if you don't want to, you're the fourth manager, you say no, you're out. This is not a dual promote structure. So we're not in a situation where the operator is giving us a 70-30 promote, and then we are then giving you an 80-20 promote, but only on 70% of the proceeds. We're actually getting better terms for you than what the sponsor would give you directly. We intend to spell out the risk of every investment. We want to make sure that people who get involved in these deals know what they're getting into, and it matches their risk tolerance, and it fits into their portfolio. And we want to build long-term relationships. This isn't a one and done type situation with a fund. This is a 10-year commitment potentially. If you want to stay in the fund, we're hoping that we get people into the fund that are interested in investing in multiple positions along the way. So we want to build trust, and we want to be, friends. So we hope that we can do that over time with a good track record. And our job is to say no with ease and yes with scrutiny, which we've been doing very well the last 3 weeks, saying no a lot. So I'm going to quit rambling there. I'm right at 41 minutes. So hopefully this leaves some time for some Q&A. And yeah, let's fire away. It looks like we have some questions in the forum here.
Yeah, we've got some questions. Thanks for submitting them through the Q&A. Pat and I will kind of moderate, and we'll hand them over to Paul. So we'll just go in order here. James had a question, and some of these you touched on in the presentation. Feel free to add to it as you see fit. Tell us about your investment thesis for the fund as a whole. Will you be what will be some of the top underwriting considerations that are non-negotiable when determining if a deal will pencil?
Well, yes, as I mentioned earlier, I think one of the benchmarks is going to be, first of all, are the inputs reasonable? not the outputs. We don't care about the pro forma projections. We want to know, are the inputs reasonable in the underwriting to get to those projections, number one. And if that passes the sniff test, then is there, when those pro forma projections are met, is there a stabilized yield comfortably above not just the market cap rate, but a terminal cap rate that's subject to move? We don't know where it's going. It could compress, it could decompress a little bit further, but we want to make sure there's enough margin of safety there where preservation of principal is top of mind as a kind of an insurance policy against a loss of equity. But we want to make sure there's enough of a spread, hopefully, where there's a good profit in there. And we find that when you ask about thesis, like if we're going to go into multifamily right now and it takes 18 months to turn a property around and it's going to produce, you know, a 6% yield on cost or a 6% cash on cash, that to me isn't very exciting when I can just stick money into a high yield savings account at 5%. Now, if we can go in and buy a neighborhood retail strip center at a going in cap rate of 7, let's say, it's got some vacancies, deferred maintenance. We've got some money we can infuse into the property and attract some tenants. There's low supply, high demand. And once we stabilize that property, we can operate at a 12 cap, which is realistic. We've got a lot of margin of safety between where cap rates are for retail, around, let's say 7 or 8 at 12%, even if that cap rate does decompress. So I'd say those are the biggest things we're looking at. Obviously, with the track record that the sponsor can execute the business plan. But if we can meet those metrics, everything else kind of falls into line.
Awesome. We've got another question here from James. Have we already identified sponsors and or deals for the fund? Paul kind of made a joke about that earlier on the presentation about saying no with ease and yes with scrutiny. And boy, that is true. We've definitely been working through some deals and haven't found any that penciled yet. In terms of sponsors, we do have some preferences. Paul, I'll let you speak a little bit to that, but we are actively reviewing deals presently and have not yet found anything potentially that meets our level of scrutiny.
Yes, agreed, Pat. I've personally, I know Ryan and Pat have looked at some deals as well and excluded some stuff without, you know, bringing it to the group as sort of a review committee. I've probably looked at 20 deals in the last 3 weeks, half of which have been a quick pass. Another, 6 to 7 have been, an hour or two and have decided, nope, this isn't going to work either. We've gotten into the 11th hour on a couple assets, did actual due diligence and site visits on a multifamily property here in Indianapolis, as well as a neighborhood retail strip center in Columbus. And, I don't want to dominate the next 20 minutes and tell you about why or, what happened and why we didn't go down the road of actually making those investments into the fund. But either one of those scenarios could have worked out really well. And one of them was more of a, we just didn't get the sense that the risk level was right for the asset. The other one was more of a subjective pass. It was that, a lot of people are overweight multifamily. A lot of people have kind of been, a little turned off by it because of some of the issues that they've had in their current portfolio. And, we just didn't feel like the appetite would be there for this type of asset, even though we thought it was a pretty decent deal. So we're looking for, the ability to be a little bit different than some of the other funds out there. And some would really narrow down and focus on one specific niche. I think being nimble has been something that's enabled me to be successful in this business. So I'm open-minded to a lot of different asset classes, as long as that risk-adjusted return is there. So sponsors, yes, we have identified some sponsors that we really like to work with. We are, again, trying to bring more sponsors into the fold that we don't have as close a relationship with, but those types of sponsors are probably not going to be the ones that we jump right on a deal with, because we don't have a track record with them. We haven't really understood, what their way of communicating is, or how, they are as people outside of work, or any of those things. So it's important when you're getting into an illiquid investment that you're going to be kind of dealing with for the next 5 or 7 years. So we're just trying to build a relationship and expose more opportunities overall. But, LFI has a fantastic community and a nice network of sponsors that you guys have, a comfort level with and know, like, and trust. And then I have some that I've worked with or networked with and have known for years through my active business, or that I've invested passively with, that have not been introduced to LFI. So those are kind of our first layer of sponsors that we're looking at.
All right. Next question. What are the fees charged by InvestWise?
It's It's going to vary based on the deal, most likely. In some cases, we may be able to negotiate like an equity boost, where let's say if we raise $1 million, that's what returns will be based off of, is that $1 million, and then the management team might get a 2% kicker or something from the sponsor for bringing that kind of capital into the deal. So in that case, we wouldn't pass on additional fees to the group. In certain cases, we may not get that opportunity. It's going to be deal specific, but I think in the, let's call it the worst case scenario, we would have like a 2% acquisition fee, and that acquisition fee is really not for us to make any money. It's sort of cover overhead. It's really to pay our due diligence costs of, visiting the asset. It's to pay for our, legal fees, accounting fees, all the back end providers that we have, and our vendors, our portal. So there is some overhead to operating this fund, and that's just to cover that. But what our intent is, as well, is to disclose those fees on a deal by deal basis and show through our spreadsheets and our underwriting how, if we've negotiated better terms on, let's say, the promotes, that even net of those fees, your investment will produce a higher return still than if you had invested directly with the sponsor. If we can't achieve that, then we're probably not going to do the deal. I mean, there's no reason to. Either we would be absorbing all that cost, or we would be passing you on a deal that has less appeal from an investment overall return standpoint. So that wouldn't work. The only case where we might do that is in an access play. Like I mentioned, we might be approaching institutional type deals where if we can bring 500,000 in capital to that deal, we're getting exposure to opportunities we otherwise wouldn't see. And we haven't done that yet. We haven't seen those types of deals at this point. We're approaching more the middle market syndicators. But when we do, we'll have to kind of play that on a deal by deal basis and see if it makes sense. But we're going to disclose everything, and it's not going to be egregious at all. It's going to be, net of fees. You're going to do better as a retail investor, and our compensation will come when the deal matures and performs. So our interests are aligned.
Great. I'll take the next two here from Tom and James. How many deals do you expect to present per year? We're targeting 4 to 6 per year, but that's obviously going to vary a little bit depending on market conditions, asset classes, deal flow we have access to, networking connections that we have access to as well. James had a secondary question for this scenario. If he's Bob the investor and he doesn't like the nth number of deals, how long is he waiting around while the second 25K is stuck making nothing? It's really until you accept that next deal. So that is a bit of a restriction. It would just come down to whatever the next deal that gets accepted is. I don't know how much flexibility, if any, we have in that regard once the deposit or once the wire is made. But if you wanted to have no capital sitting on the side, you could just do 50K into a deal that you really like, and then just not have, any idle cash.
Yeah, good point, Pat. And I think too, like, because we have the restriction of 99 investors, we didn't want to make the fund minimum 25,000 because we might, fill up that fund really fast. And if nobody's a repeat investor, our fund sort of goes dormant and becomes closed, and we have to open a new one. And from a legal cost perspective, that's pretty prohibitive. So that was part of the decision behind the 50,000. But again, we're hoping to get the type of investor into the fund who's wanting to make multiple investments over a period of time. And we intend to do 4 to 6 investments per year. So that's between 2 and 3 months we expect to have deals. But there's no pressure, I would say, to do deals just for the sake of doing deals, because that kind of goes against everything we talked about before about aligning interests. So we really want to find really solid risk-adjusted bets that we feel are strong opportunities with good sponsors. And if that takes 4 months instead of 2 or 3, then we're going to wait to find those.
Next question coming in. Would InvestWise be coming in as a limited partner or as a joint venture relationship? Either way, I'm glad to know there's no dual promotes.
No dual promotes. We could come in as a joint venture. It could be like a smaller deal where maybe, we're going to bring the entire equity check to a, smaller sponsor, smaller deal. And in that case, we might take a joint venture position. But I think in most cases, we're going to be LPs. And that's to stay compliant and above board with SEC compliance and regulations. A lot of co-sponsors or co-GPs, whether they know it or not, violate securities law. when they are supposed to have an active deal in the or active role in the deal. Instead, they just bring capital into deals, and they may jump on an asset management call. They really need to be more active in the deal to be considered a general partner by the SEC. So through our Reg D exemption, through our limited partner position as a fund of funds, we inherently are only bringing money into the deal, and we kind of reduce that exposure. So that's going to be our position. I would say 99%, 95% of the deals that we approach.
See a couple questions here about K1s. So I'm going to answer all those in one fell swoop here. From Davel, could you describe the tax implications of the fund as well? If we know as of yet, would K1s be passed through with a composite K1? Yes. So my understanding, and correct me if I'm wrong, Paul, is that each fund participant, will be getting a K1 specific to the amount of deals in which they invest. Is that accurate?
That's right. So if you're, let's say 2 years from now, we've got 10 assets in the fund, and because it's customizable and the individual investor has decided to only take 6 of those deals as positions within the fund, they'll get a single K1 at tax time with just their 6 positions represented on that form.
Yeah, and in terms of the tax treatment, depending on the type of deals you're in, there could be, depreciation, it could be, interest income, it could be any combination based on the deals in which you participate.
Yeah, you could get a K1, you could get a 1099, you could get both. Yes.
Okay. Next, Linda's asking, how long are you required to keep money in the fund, and are you able to get it out once your deals sell?
We do have a lockup period. Do you guys remember what it is? I don't remember what it is. Liquid to some degree. Obviously, these deals inherently are not liquid, 4 to 7 year holds. But if we do have maturity, or for whatever reason you've been sitting on 25,000 that hasn't been allocated for X amount of time, I think we have something in our PPM because we have to. I just can't remember that number. Ryan, Pat, do you remember it?
Yeah, I might have to look that up, but I believe committed principal to 50,000. Yes, once the deal has gone full cycle, you're able to take the principal out and earnings as they come in, whether those are monthly distributions, quarterly distributions. But the committed capital, I believe, is obviously the life cycle of that individual deal for the initial committed capital. But
yeah,
but
so we can't get that money out, obviously, because that's allocated to a sponsor's deal. But whatever the lockup period is, it's not that long. But let's just say this: on a deal, on a case-by-case basis, if there's somebody that wants liquidity and they have it in cash within the fund and they want to get it out, we can work with that person. We have the discretion as managers to help that person out.
Right. After the initial funding commitment, can we add more money later to the fund? Absolutely. That 50 is the minimum for the fund. If you want to contribute more beyond that, or if there's a certain deal that you really want to push all your chips in on, you can certainly do that as well.
And to add just a little bit to that too, to Paul's point earlier, the goal of the fund, the fund has a 10-year life cycle that it can run. And the goal of the fund is there's a 50,000 initial commitment, there's a 25,000 per deal commitment, but the goal is to have this as an ongoing fund that, to Pat's point earlier, presents 4 to 6 deals a year and gives you that optionality. So the 50,000 is the initial hurdle, but you can absolutely commit in $25,000 increments to deals that come subsequently. Go ahead, Pat. Oh, I think you're on mute.
Boy, that's embarrassing when the IT guy can't get off mute, right? Are there any specific characteristics or markets or submarkets that we're looking at? Population growth, income growth, construction, absorption, et cetera. So yes, I mean, kind of all of the above. It depends on the asset class primarily, what type of underwriting model that we'll wind up using. As to diving into the specific technical details there, I'll toss that over to Paul.
Yeah, I mean, it's a tough question to ask in a short period of time. Take a multifamily asset, for example. If we're looking at like a B class core plus asset in Phoenix, Arizona, it's obviously a growth market. Growth has slowed considerably. Cap rates are expanding. It was a very low cap market around, the 3 handle range when it was the hottest peak of the market. And now you've got a bunch of deliveries coming online. So With that, we're expecting those deliveries most likely to fill up through concessions, and that's going to put downward pressure on B-class assets, and maybe they have some vacancy issues. So that's just an example why maybe we wouldn't invest in Phoenix for multifamily. But yes, we are looking at those things with a lot of scrutiny, depending on the asset class. If you're talking about like a retail play, absolutely. Location, supply and demand are fundamentals. If you're looking at like an industrial asset with a triple net lease that's got 20 years remaining on it, less so important, because we're really underwriting the credit worthiness of the tenant, and the lease is a lot more important than the physical real estate in that case. Is that business going to maintain that facility? Are they going to have operations there in 5 or 10 years and we choose to exit and sell to another investor, or roll it up with a bunch of other industrial assets into a PE type situation? So it's very, very deal specific, asset specific, location specific, but we are absolutely looking at market fundamentals, growth, population trends, etc.
All right. Kind of tagging onto some of the earlier questions, if we contribute capital and deal flow is stagnant, or there are no deals we want to invest in, and can we withdraw capital? Or if we invest in a deal and it goes full cycle, are we able to take those funds out while maintaining the 50,000 minimum?
Yes and yes.
Okay.
All right. Are you only bringing passive deals, fund of funds, or will you have any of your own active deals? This is something that we discussed kind of during formation. Right now, primarily, we're looking at fund of fund model. But I believe, I mean, if the right deal comes along, we're kind of agnostic to that structure.
Yeah, agreed. Again, it's probably, I would say the focus right now is on passive opportunities. My core competency is in multifamily, and in my local area where I feel strongly that you need to have boots on the ground. I'm not going to try to go expand into some other market. And right now the bid and the ask are pretty far apart. So I'm not going to be personally bringing anything from that standpoint. And I think that underwriting things passively and looking at a spreadsheet and evaluating risk in an asset that you don't have active experience in is very different than assuming that you can just go be a retail operator, for example. The relationships, the unfair advantage in the market, down to the contractors, the property management, et cetera, takes a long time to build out, whether you know what you're doing or not. So we would rather take the approach of teaming up with operators that have core competencies in their local markets with boots on the ground and unfair advantage in other asset classes. So for that reason, I think that we'll probably be just participating as limited partners. But our PPM does give us the opportunity to bring active investments into the fold if we see fit down the road. And of course, you as the investor will have first right of refusal on those deals if they do pass our underwriting criteria.
Okay. Jeff asks, will monthly or quarterly distributions come from InvestWise or direct from the operator?
They'll come from InvestWise. I'm guessing that we're going to get distributions in a lumpy fashion. We might get some that are monthly, we might get some that are quarterly. So I think being on a proper cadence where we can kind of give them all at the same time is best. So I'm guessing we're probably going to go to quarterly distributions, and that'll help us from an administrative standpoint as well. In the case of like a development deal, which we're not really looking at right now, where there's not really any cash flow distributions and it's more of a appreciation play, there might not be cash flow. So, but we're more cash flow focused than we are speculative. So with the deals that we underwrite, we're probably going to have free cash flow available to distribute. We'll get that from the sponsor into the fund, and then the fund will distribute it to the individual investor.
Next question. How much capital will you as the fund GP, are you as the fund GP looking to invest in each deal you're bringing in onto investors? We're doing at least the deal minimum of 25K. In certain deals, probably more if we really, really like it. And since I'm off mute, I'll take Stefano's question. Can a tribe invest in the fund? The answer is yes, but that from a legal perspective, that might blow up the 99 seats. If we have 10 funds of 10 people each, that's going to put us over the threshold for the number of investors that we can have in the fund. So there is a look-through provision, is my understanding. And then each individual tribe member would need to be accredited individually and provide proof of that because of the 506C regulation.
Okay, and last question in the chat. How will you handle communication to investors on an investment? For example, will you be communicating monthly, or will you be communicating or the GP?
We're going to take the communication responsibility. We'll obviously get updates from the GP to us directly. That'll be generic in nature. And then with the check sizes that we intend to write and the relationship that we look to maintain, we'll be in contact with those GPs to get more information. So it's more detailed. And then we'll consolidate, the information that they provide us with additional context that we see to give like an overall perspective of where the deal is.
And part of that too is also saying, hey, maybe you haven't heard from us in a while, but here's some of the not necessarily deal specific things, but we've reviewed a certain number of deals. Some got close. We'll just kind of give you a pulse of the fund operations as well. And then, are you also planning quarterly distributions on debt investments as well?
I'd say for now, yes. But again, that's deal specific. I think debt is going to be a lesser focus than equity. So although I think debt right now offers some really strong risk-adjusted returns and being lower in the capital stack. So we're very interested at this moment, but I think on the whole, we're looking for more upside too. So it may be, 80-20 as far as the composition of the fund. It may be 90-10 equity to debt. But we'll have to see how those debt positions play out and how we're getting paid as a fund before we know. But again, back to just wanting to keep everything consistent. I think if we can kind of streamline our distributions to be at the same time, that would be ideal if we can do that. So quarterly is probably the best way to handle that.
All
I
right.
think that's
I don't see any
that's
more
it for
questions.
questions. Sorry, Ryan, didn't mean to interrupt you. I
Nope,
just wanted to
that's-
jump in here and say something real quick, and then I'll let you guys close out. I think I said in the opening when I first spoke, I probably said how excited I am about 6 times. And I just want to add a 7th, because after that presentation, I mean, it's just impressive what these guys are doing, the knowledge and the just comfort knowing that you're investing alongside people like this. At least it's comforting to me. I have a ton of deals coming across my desk every day, and I try to spend time or find time to evaluate them, but I can't evaluate them the way Paul, Ryan, and Pat do, spending the time to dig into it. And so that's why this is of such interest to me. And that's also why LFI is committed to supporting InvestWise Collective. And we're really happy and proud that we can present this to our community. This does not replace deal webinars at all. Like, these guys are talking 4 to 6 deals a year, right? And maybe they get up to 8 or 10. Deal webinars, we've been doing a couple of those a week. So this is in addition to, right? This is another layer. Deal webinars is completely do it yourself, right? You're going to watch the webinar, then you're going to make your own investment decision. You might go on the forum and talk to people and community the deal like we talk about, but at the end, you're going to make your own decision, right? The difference here is these deals are going to be curated, brought to you by InvestWise Collective. You'll still have to make your own investment decision, but you know that you have others investing alongside you. So I'm just really, really pleased and excited that these guys have devoted the time to it. So I just wanted to mention that, and I'll leave it to you guys to close. But thank you so much. This was so impressive, and just fired up to see where we go.
Thank you, Jim. And thanks everybody who attended today. It's an honor to present in front of you. I've had conversations with a lot of you guys. I see your names in the participant list here over the last few weeks, and I've really enjoyed getting to know you and hope that we can, build on that and have a relationship long-term. I'm going to put my contact information back up here again. This is my cell phone number in the bottom corner of the screen here. I try to be as available as possible. Text is best, but if you need a call back, just let me know and I will definitely get back to you. You can also email me any questions, and I know Pat and Ryan are open to being available as well. So we look forward to building on this and hope to have an opportunity soon. I will say, to kind of piggyback off of what Jim said, we're not, registered investment advisors. We're not here to tell you this is a great investment, and I'm here more to talk you out of something than I am to sell you on it. I think I don't know if you picked up on sort of my bearish mentality, but I think that there's been a lot of hype in this industry over the last couple of years, and we need to come back down to earth a little bit. There's still some great opportunity out there, and we intend to find it, but we're not registered investment advisors. We're just three guys with capital who do this a lot of the day, if not all day long, for our jobs. And we're looking for places to put our money. And if we can negotiate better terms for you guys, we'd invite you along for the ride. So again, thank you very much, and look forward to catching you guys soon.
And I know a lot of you, just to tag on to what Paul said, I know a lot of you are on the InvestWise Collective email already. In the chat, I threw the link to the InvestWise Collective website where you can fill out your name and contact information if you'd like to stay in touch with what InvestWise has presented. So otherwise, thanks everybody for joining. Great job, Paul. Pat, Jim, anything to close out?
Yeah, just want to echo and reemphasize everything that Paul, Ryan, and Jim has said. I won't bore you guys with saying it all in my own words. There was a question about the recordings that will be sent out as soon as it's available and ready for us, both to our mailing list and to the LFI community. So those of you who are joining late or watching at a later date, hello. And yeah, other than that, just very excited to get started and start working on this together.
Excellent. Well, thank you, everybody. As you said, just go to investwisecollective.com, sign up, join it if you're interested, and schedule a call with Paul or one of the guys. Thank you for being part of the Left Field investor community. We are very pleased to be able to bring you this opportunity and others. And if you have any questions, you know where to reach us. So thank you, everybody.
Thanks, guys. Bye-bye.